know what's up. We're the Harlem Globetrotters, and you're watching Take It Stop. Who you with? Who are you with? My brother and my sister.
Let's do it, folks. Time to rock and roll. 2 minutes to go here into the closing bells. Much more of a defensive tilt to today's tape here on Wall Street, with the S&P 500 and the NASDAQ both pulling back just a little bit after another round of all-time highs in yesterday's session. The one and only Peter Tuchman, the Einstein of Wall Street, joins me now to kick off today's broadcast.
Awesome. Thank you, sir.
What did you see? Pretty constructive tape despite a lot of red on the board?
I think so. Look, we're going to see little pullbacks. Those are constructive. When you're building, even if you go back to what a trend trade is when it's going in one direction, it pulls back to the 9 or the 15 exponential moving average. It shows strength foundation to the trade. Same thing with the market. We're going to have those pullback days with no decision basically met about which direction we're really going to go from here, but the market seems there's enthusiasm about the market. You're probably going to see 50-50 advance versus declines. People are getting out of the things that were either overperformers for them or underperformers and getting into some value, and so it's good. It's a good market. I feel it's strong.
Before I let you go, are you emboldened? Is it a good sign that we're not going to close at session lows today? We're off session
100%.
lows.
We hit a double bottom earlier in the day. We spent the rest of the afternoon rallying up until the close. So I think it's a spectacular close.
All right, and it's time for an early bell. Thank you.
Happy trade.
There you go. I'm hyped up. If you're 3M, you get to ring the bell for 30 seconds and hit the gavel 4 seconds. Great Dow component. Special thanks there to Minnesota Mining and Manufacturing, longtime Dow component, New York Stock Exchange listed stock, 3M. What else do I want to run through here? More of a defensive tilt. Energy, staples, real estate, your strongest performing sectors in the S&P 500 today. For your risk-off trade, technology, discretionary, and material stocks lag the S&P. Also at this hour, the Magnificent Seven in mixed territory ahead of 5 cannot miss earnings reports set to launch over the next few days. Microsoft shares up about 1% ahead of earnings tomorrow. Meta shares down about 1%. As for the Dow 30, which of course does include the great company of 3M, Coca-Cola, UNH, IBM, those are your Dow outperformers. Your Dow component laggards, Home Depot, Sherwin-Williams, as well as Cisco. Let's bring in the great Phil Rosen, Chief Market Strategist at ProCap Financial. There's a lot going on here, my man. First of all, thank you for being here as always.
Thank you for having me, JD.
We got can't miss big tech earnings coming up, but I want to get your take on market leadership, where we are for these names. Without NVIDIA, are the Mag 7 now the slowest growers, or at least slower in the S&P, all things considered?
So that's what I wrote in my newsletter this morning, and I highlighted how, according to FactSet consensus estimates, the Mag 7 are expected to grow earnings at about 23-24% this quarter, but if you take NVIDIA out, that drops down to about 6.5%. So that's actually below what the S&P 493 expects at about 10%. So the story around the Mag 7 being market leadership, top heavy, big tech, that kind of goes away if you pull out NVIDIA. And NVIDIA, they've made a living of crushing earnings every single quarter, and that's going to continue. But the rest of the Mag 7 have really slowed down, and we're going to see that starting this quarter.
Tomorrow we've got Microsoft, Meta, Amazon, and Alphabet. We'll get Apple on Thursday. What do those big tech names, the most consolidated names in the S&P 500, what do they need to prove?
They're probably all going to do just fine. They're going to report great results for the quarter, but the thing that the street is going to be watching is if they raise their CapEx expectations for the rest of the year. If they come in, any one of these names, and say, hey, we're adding 5, 10, 20, $30 billion of spend for the AI data center build out, the street might react negatively to that because they've already piled on so many billions of dollars of spend expectations over the last couple years, and if they add to that more, we could see a negative stock reaction. But again, long term, I think these companies will do just fine. These are massive, massive giants. They have huge balance sheets. Even if they spend a bit more than expected, that doesn't break the long-term bull thesis.
I want to get your take. What are we seeing in terms of breadth and overall market structure? It's one thing for the lieutenants, the generals at the top of the pack to do the heavy lifting. You want to see some breadth and some smaller names in on the fun as well.
The S&P 493 are actually looking really solid over the last few months, and we can see this in the equal weight S&P 500 index. It's actually keeping right there with the market cap weight. I think they're both up about 4.5% for the year, and when those are matched or equal in performance, that's when you know the 493 are really pulling their weight, and it's not just a Mag 7 story as it's been the last couple years. So I think this is a great sign for the secular bull market to continue. You want that broadening out, you want that rotation, and we're right there.
Since this is probably the last time you and I will speak before the tranche of earnings, before Fed Day, before PCE, any other big catalysts you're paying close attention to over at ProCap you think the rest of us might also benefit from focusing on a little bit?
You know, the big thing we didn't touch on is the Fed. Jerome Powell's going to have his legacy-defining press conference on Wednesday, and that's probably going to be his last time as Fed chair giving a presser. But the thing to watch is whether it's his last time in the Fed moving forward, because he might stick on for another couple years as a governor. We don't exactly know. There's some political ramifications there. There's questions of Fed independence, but otherwise, that's what I'm watching right now.
Wow, the final day with Jerome Powell. It doesn't even feel real, but we will have that press conference tomorrow at 2:30, a half hour after the FOMC decision on short-term interest rates at 2 o'clock. I don't think we have you on the show, but I'm sure we'll be texting.
We will be. I'll be watching. Yep.
The great Phil Rosen, my man. Thank you for
you.
being here. Skylar, grab your mic. All right, here's some of the latest analyst calls that moved today's tape here on Wall Street. First up, Barclays reiterating Tesla as overweight. That company remains the laggard of the Magnificent Seven so far year to date, but still outperforming the S&P 500 over the last year. Next up, Citi reiterating Palantir as a buy, but lowering its price target from 260 to 210, calling it a top AI beneficiary. And finally, B of A upgrading TFI International to a buy rating. That is a trucking and logistics company. TFI up about 30% since the start of the year, up 40% off their mid-March lows. We'll take a look at two notables that called the New York Stock Exchange their home and had good earnings reports today. We'll start with a defensive name in Coca-Cola, a beat on the bottom line, 86 cents versus 81 expected, topping the street's expectations, also lifting its full-year outlook. Maybe some weakness from budget-conscious consumers, but they do have premium brands as well. Shares of Coca-Cola up more than 3% on the day, up about 8% from the start of the year. Bobby, let's swing around and take a look at auto giant out of Detroit, General Motors, with a good tape, up 1.2 today after lifting its 2026 guidance. One of the big questions, the tariff refund after the Supreme Court ruling could be as much as $500 million. We still wait and see how that plays itself out. Shares are down for the year, but up 67% over the last 52 weeks. All right, last week here at the New York Stock Exchange, I sat down with CEO Jim Keller of Tenstorrent. We talked all about their new AI video processing hardware and much more. Take a look. Jim Keller joins us now. Jim is the CEO at Tenstorrent. Very grateful for your time, Jim. Thanks a lot for being here. So let me start with this. We're seeing a lot of consolidation and a lot of competition in the broader AI hardware space right now. Who do you think is winning the data center arms race at this moment?
Well, I think, well, obviously NVIDIA is the leader, by market cap, by volume. But boy, there's a whole lot of new entries coming in. All the hyperscalers are building their own silicon. We're building some really great AI products. And, I think there's a really big state of change, partly because AI is new and partly because the models are changing.
Jim, I assume that this is a thesis that you and your team at Tenstorrent would agree with. The faster your hardware, the faster you can generate videos. What does that thesis look like for the company right now? You've been in the middle of a lot of exciting announcements as of late.
Yeah. So one thing is video is a really big computational problem. It takes a lot of compute, a lot of memory. You really need to be able to scale it. We built our AI accelerator as a networkable device, so we can hook quite a few up together, and that gives us the capability to really drive video fast. We are now doing 5 seconds of video in 2.4 seconds, which is for AI is amazing.
There was so much chatter about this with regards to the evolution of video generation speeds. Like you just said, 2.4 seconds to generate a 5-second video. What do you think that unlocks that simply did not previously exist?
Well, one is continuous prompting. That means that you can literally generate video and keep prompting it and really tell a story with it. And with a few more tools on top of that, where you can, do cut frames, new scenes, camera moves, it's really going to be great for storytelling for creators to go do new things.
I wonder what the secret sauce of all this is, because you're claiming 10x faster performance relative to your competitors. And so I wonder, is it the black hole portion that makes this so effective? Is it the open architecture part of the conversation? Is it both or something else entirely?
Well, first of all, our black hole chip is a native tensor processor. Tensors are the fundamental math unit, computational unit of AI. But it's really the key is to have a balance. We have a great tensor processor, on-chip SRAM, local DRAM that's high bandwidth, and most importantly, networking on every chip so we can scale them up. People made a big deal about, well, we have in SRAM compute. Well, that works for a subset of applications, but it's not a magic bullet, and it doesn't give you the capacity to do something like video.
Jim, help us better understand how different your approach is, an open, non-proprietary stack. First of all, what should people know about the way that you're going about business, and how different is that from the norm?
It's well, it's the fundamentals of computation are sort of the same, but on the software side, we open source our full software stack. That's from our compiler, our DSL, our like operator library, and our low-level drivers and bare metal kernels. So we've open sourced that, which some people really like because they can see the whole software stack. It allows certain kinds of innovation. The other piece is we really solved the data placement, data movement problem at a very low level of the stack. That means for us scaling to hundreds of AI accelerators is a straightforward operation. We are currently demoing our hardware with 660 AI accelerators connected together. It's very stable and easy to program, and we're going to keep going bigger. So we have a difference there. We don't need special InfiniBand, special networking, special stuff. It's a pretty natural act for us to scale up our accelerators.
Jim Keller is the CEO at TenStor, and very grateful for your time. Congratulations on a lot of really exciting announcements as of late. Come back and see us soon.
Oh, great. Great to see you. We'll be in touch.
Welcome back to the show. Bitcoin is now trading at institutional level depth, and here to talk all about it is our next guest, Adrian Fritz, Chief Investment Strategist at 21 Shares. Nice to see you. Thanks for the time today.
Thanks for having me, JD.
Is it in your view that Bitcoin right now is, or at least should be, a core allocation instead of just its own trade?
I think it should be, and I think it's becoming consensus as well. I mean, even the big asset managers, they kind of say something between 2% till 6% should be in a multi-asset portfolio. So I think it's not if you should own it or not, it's really about sizing and how you bring it into your portfolio.
I wonder what you've seen since the end of the February, since the start of the conflict in Iran and the broader Middle East region. Is geopolitical risk now a key driver of Bitcoin flows? What correlation have you recognized?
I wouldn't call it a key driver, but we've seen in the past that Bitcoin kind of acts as that chaos hedge almost. I mean, it's performing quite nicely. I mean, it's up almost 20% since the start of the war, and therefore, I mean, it's been reflected in ETF flows as well.
Yeah, of course. Let me ask you about sticky capital. Are institutional flows making Bitcoin less volatile? And is that more of the story of BTC's overall resilience as you've seen it?
I think in the long run, of course, Bitcoin is being institutionalized. It will get, the volatility is coming down. We've seen this historically. And of course, it comes with the ETFs as well. But as you said, the sticky money is quite surprising. And I think it's not actually necessarily about the size of the flows. I think what's more interesting is actually the timing. Because of course Bitcoin is still under its all-time highs, but we see those traditional investors allocating and taking positions.
Yeah, over the course of the last few weeks, we've been talking a lot more about recent efforts from groups like Morgan Stanley and others, MSBT, just their latest iteration. Is Wall Street about to own the next leg of the crypto rally? And how do you look at the continuation of the institutionalization conversation?
I mean, of course, it's the spotlight is on Bitcoin. I think we got to be a bit more patient. But also, if we look at the flows, like 80-90%, it still flows into Bitcoin. All the rest, like Ethereum, Solana, I think we first need to find a footing in regards to Bitcoin, and then slowly, with the right educational efforts, Wall Street will enter there as well, yes.
How close are you tracking the latest developments out of the Clarity Act? I feel like we've been talking about this thing for so long.
Yeah,
and
we
it's a
all been talking
midterm
about
election year, but it is one of the top priorities for at least a lot of lawmakers. And how are you thinking about it, especially in a midterm election year?
I mean, of course, we expect it to pass before the midterm elections. Do I see it as a massive catalyst to really get us out of this bear market? I don't think so. I think that's a bit overblown. I think it's a very important regulatory piece for the long run to bring more institutional confidence. But as a short-term catalyst, I don't see that. I think it's a bit too much.
Adrian, before I let you go, what is one reality of the broader cryptocurrency landscape that you wish more people were paying attention to?
I would bring it back once again. I think it really becomes consensus. It's not, we don't fight for existence anymore. The narrative has changed. I think it's really about like understanding and making up their mind on how to bring it in a portfolio, and I think that's beautiful to see.
Adrian Fritz, Chief Investment Strategist at 21 Shares. Great interview. Thanks a lot for joining us.
Appreciate it.
Come back anytime. A lot more Taking Stock coming up live from the big board after this. Welcome back to the show. At this hour, time for the latest headlines in the world of fintech, crypto, and artificial intelligence headlines you need. First up, all the crypto majors are down. Bitcoin right around 76,382. Next up, OpenAI linked stocks are under pressure after reports that the company missed key sales and user targets, raising fresh questions about AI spending and dragging partners like SoftBank and Oracle lower on the day. And finally, according to a Bloomberg News analysis, most prediction market traders are losing money. Pardon us, folks, thank you. While bots and top players scoop most of the profits. According to the report, the top 1% are taking the majority of gains, while nearly 70% of traders end up in the red. So what is really driving the artificial intelligence boom right now, and what are markets missing? Last week on the JD Durkin Show, I spoke one-on-one with Zaid Admani of The Rundown for a look at the hype and what it means for where markets may go next. Take a look. If you follow the money of the big tech power players, which I know you do very closely, are you seeing an AI boom, or is it a little bit more of a chip boom right now? Or in general, are we just not describing the enormity of this moment we're in the right way?
Well, I mean, I think it's the semiconductor stocks that have really outperformed this year, right? Like, especially, I mean, recently there's been a decent surge in some of the AI companies, but for the most part, it's the chip companies. TSMC near all-time highs. They just reported earnings a couple weeks ago. They crushed it. Texas Instruments, they're crushing it. So all these like semiconductor companies, they're the ones that have really benefited right now. I mean, SanDisk is what the best performing stock in the S&P this year. So, I mean, it really is a semiconductor story right now. Whereas like the big tech companies, while they've recovered a bit, I mean, they've kind of struggled up until recently.
I mean, it's wild. SanDisk, Western Digital, Lam Research. These numbers are like absolutely insane. I'm taking a look at SanDisk here.
1,000% or 2,000% over the last year. It's insane, and it just keeps going higher.
52-week return, 2,935% for SanDisk. What are we doing here?
Yeah, the company that made SD cards is now just an AI player. I mean,
I was gonna say, if you're a photographer and you know your way around a DSLR, you know the little 128 SanDisk cards, and now it's like it's hot to trot. You cover a lot of viral business stories. You do a great job with them, the way you tell the story and you make it make sense for people. Let me ask you about HIMS. That stock has been ripping. This was a $14 stock, Zaid, in mid-February. It's now a $29 stock. Can that story survive a broader GLP-1 crackdown?
I mean, the HIMS is just what happens to HIMS is going to be dependent on what the FDA decides to do. The biggest risk there is regulatory risk, right? FDA comes out with new rules to remove some of the regulation. The stock pops. FDA says they're going to crack down on GLP-1 copycats. The stock tanks. If there's a lawsuit from one of the big players like Novo or Eli, the stock tanks. So I don't know. It's just there's a lot of risk there, but it's turned into like a mini meme stock. And if you can kind of catch it in the right week, you can make a return there.
You mentioned regulation. Do you think we're heading into a wave of regulation for a lot of these high-flying companies?
I don't think so. I mean, I don't know if the Trump administration is reluctant to do that. I mean, I think they're trying to do deregulation from everything that I've seen. They're trying to like get out of the way. So I can't imagine they're going to start, putting AI regulations and whatnot against some of these big high flyers.
That's an interesting look, because Krista and I were talking about the midterm elections. When we get closer to the presidential cycle for 2028, how do Democrats position against these? If you're Gavin Newsom and you're running for president, are you out there be like, I'm going to be the president of regulation because the high-flying names that were allowed to do whatever they want under Trump, like they got to be reined in? I think the business community would fight against that. That's going to be an interesting one. I want your take on where geopolitics meets markets. Of course, the Strait of Hormuz. What is the first domino to fall for the markets, you think, if something happens there? More broadly, how are you thinking about the relationship between the essential closure of the strait and how it's impacting the rest of the markets?
This is the stuff that just blows my mind, right? Like, the strait is still closed. It's been closed for, 4, 5, 6, going on 6 weeks now. Oil prices are up, but they're still only like $100 a barrel. You would think with 20% of the supply choked off, we would be looking at 120, 130, 140. I'm still shocked by it. I personally think that it's underpriced. Obviously the market's usually never wrong. So they must know something that I don't. But yeah, I mean, that's the biggest thing here. And I'm still, one thing that I did notice though, over the last 4 to 5 days, essentially this week, typically when oil prices would go up, stocks would go down. That pattern kind of broke this week, because I mean, we're still seeing prices go up even as of today, right? Prices are up compared to what they were last week, oil prices, I mean, and the market's still ripping higher. We're still looking at all-time highs. So like that trend that we saw over the last month or so, that's fully broken. And now everything's going up. Oil prices are up, stock market's up. Clearly investors are more focused on the earnings story right now than the geopolitical story and like the fear of higher energy prices.
Time for startups raises and rounds. First up, Bill Ackman set to launch a rare double IPO, floating both a new fund as well as his management company, all while offering free shares and lower minimums in order to draw in everyday retail investors. Next up, former DeepMind researcher David Silver raising $1.1 billion for ineffable intelligence, aiming to build a new kind of super learner that can train itself without human data. Finally, SpaceX tying Elon Musk's compensation to extreme performance targets, including a $7.5 trillion valuation, space-based data centers, and a 1 million person Mars colony. All right, Money 2020's very own Scarlett Sieber is now back with to explain the ways that fintech companies really make money. Take a look.
I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make that cash, where we look past buzzwords and focus on the parts of finance that quietly generate real revenue. Today, we're talking about artificial labs, and this is a perfect example of a fintech succeeding by modernizing an industry from the inside, not trying to blow it up. Commercial and specialty insurance is enormous. It's global, it's profitable, and operationally, it still relies on a shocking amount of manual process. Artificial Labs builds digital brokering and underwriting platforms for complex commercial insurance, replacing spreadsheets, emails, and fragmented workflows with software designed for real underwriting decisions. So how does Artificial Labs actually make money? First, enterprise SaaS contracts. Large brokers, carriers, and MGAs pay recurring multi-year contracts to use Artificial Labs as their underwriting and placement platform. This software sits directly in the risk selection workflow, which means it's treated as a core infrastructure, not as a nice-to-have tool. Second, long-term institutional deployments. Once implemented, Artificial Labs is rolled out across teams, product lines, and geographies. That not only expands its revenue over time, but it also creates durability. Third, deep workflow ownership. Artificial Labs doesn't sit alongside underwriting decisions. It is where the underwriting happens. That level of entrenchment creates real switching costs in a heavily regulated environment. Here's the thing about commercial insurance. It's conservative by design. Systems change slowly, but when they do change, it's usually because the old way has become too inefficient to sustain the margins. So that, my friends, is exactly why Artificial Labs is gaining momentum right now. Underwriting margins are under pressure. Manual processes create inconsistency, and regulators expect transparency and auditability that, let's be honest, spreadsheets just simply can't deliver. That backdrop showed up clearly in the company's funding. In February 26, Artificial Labs raised 45 million Series B, and they did this all about scaling globally and expanding into the US market. This wasn't investors chasing hype. It was a bet on slow, inevitable modernization. So what is the moat exactly? Regulatory complexity combined with workflow depth. Underwriting platforms must satisfy internal risk teams, executives, auditors, and regulators all at once. Once a system does that reliably, replacing it becomes risky and expensive. Artificial Labs isn't trying to disrupt insurance, it's trying to run it better. And that, my friends, is how Artificial Labs actually makes that money, by becoming the system insurers rely on to price risk consistently, compliantly, and profitably year after year. Not flashy, not consumer facing, but exactly the kind of business that compounds quietly. Have a fintech that you want us to feature on the show? Drop it in the comments, and it might just make the cut. In the meantime, back over to you.
The Fed's decision on short-term interest rates crosses the wire tomorrow at 2 o'clock. The final Jerome Powell press conference at 2:30, and then can't miss tech earnings. Microsoft, Amazon, Meta, Google, and more. Thanks for watching today's edition of Taking Stock. Have a good one. We'll see you again tomorrow. Woo!